In this video, I'm going over everything you need to know about the IVV ETF listed on the Australian Stock Exchange. Hi everyone, and welcome to the series on exchange traded funds or ETF investing, where I look into specific ETFs and show everything you need to know about the product offering before buying shares of the fund. ETFs are personally my favourite way to passively invest, as it takes the stress and worry out of stock market investing, which can be very volatile with wild price swings holding individual stocks. We will go over the ETF Fact Sheet, including the management fee, the index the ETF tracks, dividend yield, payment frequency, and the fund's performance. I will also go over the top 10 holdings in the fund, as these typically make up the largest portion of the weightings and resulting performance of the ETF overall. It is always crucial to understand what you actually own in these ETFs before buying them. If there's any ETFs you are interested in and would like me to make a video on, write it down in the comment section below. IVV is an ETF provided by Blackrock, who own and operate the fund. Blackrock are the ones who actually own the underlying shares in the individual companies. So when we buy shares in the ETF, we buy from Blackrock, who continually issue new shares in an open-end fund and not the individual companies inside the ETF. Now IVV aims to track the performance of the SP500 index before fees and expenses, which is a diversified large market cap US index that holds companies across all 11 GICS sectors representing the best of America. Stick around to the end of the video, where we'll see how good the performance and returns of IVV have been over time. IVV was launched in 2007 in Australia and acts as a feeder fund to the US variant, and it is now domiciled in Australia, whilst offering exposure to one of the world's well-known equity benchmarks. While IVV certainly may have appealed to investors seeking to build a long-term portfolio and include large-cap US stocks, this fund has become extremely popular with more active traders, as a way to toggle between risky and safe assets. The SP 500 ETF seeks to provide investment results that, before expenses, correspond to the price and yield performance of the SP 500 index. This index is composed of 500 stocks, all of which are listed on national US stock exchanges, and spans over approximately 24 separate industry groups. To find the ETF in your brokerage account, you will need to type in the ticker code IVV to bring up the options to buy or sell shares in the fund. It pays distributions, which are dividends from the ETF, 4 times a year at a 12-month yield of 1.5%, and has a management expense ratio, or MER, of 0.04% per year. So for every $10,000 invested, it will cost $4 per year in fees. This isn't a bill you have to pay immediately. It is automatically deducted from how much money you have invested in the ETF, so you never really notice anything being paid or taken out of your brokerage account. Now, since this ETF tracks the S&P 500 index, it covers the broad American market and a range of industries. Unsurprisingly, the information technology sector is the largest, with big tech heavyweights making up the largest portion of the fund at 27%, followed by healthcare at 14% and consumer discretionary at 13%. Real estate, energy and utilities make up the smallest sector allocation, all under 3%. With its strong focus on American companies with favourable corporate tax rates and American entrepreneurship, IVV provides the best of America, which has consistently performed over many decades. And with its tilt towards innovation and technology, it provides diversified exposure to a high growth potential sector. In one trade, we get access to companies like Tesla, Apple, Facebook, Amazon, and Google that are changing the way we live. An important factor to consider when investing in ETFs that track overseas markets is currency risk. Many fund providers offer a hedged and unhedged version of their ETFs, which essentially means they hedge against currency fluctuations by taking out a contract called a forward foreign currency contract. Simply put, these are contracts where two parties agree to exchange currencies at a fixed rate at a date in the future, regardless of what the actual foreign exchange rate does in the meantime. If exchange rates turn against you, the investment return will suffer and underperform the index the ETF tracks. On the flip side, if currency exchange rates turn in your favour, you actually get a slightly better return than the index. For example, if I buy one share of the ETF at $10 per share, and the index it tracks doesn't change, but the Aussie dollar weakens by 10% against the US dollar, the share would now be worth 11 Australian dollars, so it helps in this case. However, if it goes the other way, where the Aussie dollar strengthens by 10% against the US, then my one share would now be worth 9 Australian dollars, assuming the index stays the same value. Living in Australia, I always look for Aussie domiciled ETFs, as it makes tax returns easier since I'm not technically investing overseas in the US. Instead, I'm buying shares of the Australian-based fund that own the international stocks, so there is no need to complete any W8 BEN forms for Australian taxation purposes. The W8 BEN form is a legal document required by the US tax authorities and is used to declare an individual's tax status to the Internal Revenue Service or the IRS. It's only required for non-US residents, and by completing the form, you may be able to claim a reduced rate withholding tax. In the second half of 2018, IVV was converted into an Australian domiciled ETF, removing the need to complete US tax forms, so this makes things easier for us to manage taxes and estates on our side. If you're enjoying this style of video, feel free to give it a like to let me know and subscribe for more. Now, when purchasing shares in an ETF, I like to have a basic understanding of the top 10 holdings, as these companies will have most of my money allocated to them, and they will end up driving the bulk of the fund's performance. So we'll quickly go over which companies are in the ETF's top holdings and what they do to make money. Johnson & Johnson is an American multinational corporation founded in 1886 that develops and sells medical devices, pharmaceutical and consumer packaged goods. Most of Johnson & Johnson's total revenue comes from its pharmaceutical segment. Medical devices refer to sales of devices for orthopedic surgery, cardiovascular and vision care. Its most well-known consumer products are the Band-Aid line of bandages, Tylenol medications, Johnson's baby products, and Neutrogena's skin and beauty products. Visa is an American multinational financial services corporation headquartered in California. It facilitates electronic fund transfers throughout the world, most commonly through its Visa-branded credit cards, debit cards, and prepaid cards. Visa does not issue the cards, extend credit, or set rate and fees for consumers. Instead, Visa makes money by providing financial institutions with Visa-branded payment products that they then use to offer credit, debit, prepaid, and cash access programs for their customers around the globe. Berkshire Hathaway is an American multinational conglomerate holding company, headquartered in Omaha, Nebraska. The company wholly owns Geico, Duracell, Dairy Queen, BNSF, along with significant holdings in public companies such as Kraft Heinz, American Express, Coca-Cola, Bank of America, and Apple. It makes money from their wholly owned businesses in insurance, rail, transportation, energy, distribution, manufacturing, and retailing, along with dividends and capital appreciation in all of their portfolio holdings. JP Morgan Chase & Co. is an American multinational investment bank and financial services holding company headquartered in New York City. The company makes money by providing services including consumer banking, investment banking, commercial banking, and asset management for individuals, corporations, institutions, and governments globally. Facebook is an American online social media and social networking service based in California. It was founded by Mark Zuckerberg along with fellow college students in 2004. Facebook sells ads on social media websites and mobile applications. Ad sales are the primary source of Facebook's revenue, and it is experiencing increasing demand for advertising amid the shift to online e-commerce. Tesla is an American electric vehicle and clean energy company based in California. Tesla makes money selling its products including electric cars, battery energy storage from home to grid scale, solar panels, and solar roof tiles, along with related products and services. The purpose of Tesla is to help expedite the move to sustainable transport and energy, obtained through electric vehicles and solar power. Alphabet is an American multinational conglomerate headquartered in California. It was created through a restructuring of Google in 2015 and became the parent company of Google and several former Google subsidiaries. Alphabet leverages its search, web browsing, and mobile operating systems to make money through the sale of advertising, apps, subscriptions, hardware, licensing, and service fees. Advertising generates the majority of revenue, with Google Cloud also growing very fast. Microsoft is an American multinational technology company with headquarters in Washington. It makes money by developing, manufacturing, licensing and selling computer software, consumer electronics, personal computers, and related services. Its best-known software products are the Microsoft Windows line of operating systems, the Microsoft Office Suite, and the Internet Explorer and Edge web browsers. Its flagship hardware products are the Xbox video game consoles and the Microsoft Surface lineup of touchscreen personal computers. Amazon is an American multinational technology company based in Washington. It makes money through its many business segments involved with e-commerce, cloud computing, digital streaming, and artificial intelligence. Amazon was founded by Jeff Bezos in Washington during 1994. The company started as an online marketplace for books, but expanded to sell electronics, software, video games, apparel, furniture, food, toys, and jewelry. Apple is an American multinational technology company headquartered in California. It makes money by designing, developing, and selling consumer electronics, computer software, and online services. The company's hardware products include the iPhone, iPad, Mac, Apple Watch, Apple TV, AirPods, and the HomePod smart speaker. Apple develops software to run on all their hardware, along with professional applications like Final Cut Pro, Logic Pro, and Xcode. Its online services include the iTunes Store, iOS App Store, Apple Arcade, Apple Music, Apple TV, and iCloud. Now, ETFs are considered to be low-risk investments because they are low-cost and hold a basket of stocks or other securities, increasing diversification. For most individual investors, ETFs represent an ideal type of asset which builds a diversified portfolio. Still, unique risks can arise from holding ETFs, as well as other special considerations paid to taxation depending on the type of ETF. Since inception, IVV has had an average annual return of 5.1% per year before taxes, and a total cumulative return of 181% with dividends reinvested for the entire time the ETF was running, which goes to show the power of dividend reinvestment and the compounding effect over time. Now, of course, past performance is no guarantee of future performance, but it's always a good sign of consistently improving business fundamentals, continually driving each individual stock higher within the ETF. I prefer to look at the cumulative returns as it includes the dividends paid to shareholders, which should always be included as we're getting some value back, plus with the dividends reinvested, this is what provides the compounding effect, exponentially increasing our returns the longer we have our money invested in the fund. This is the sort of approach I take investing for the very long term using ETFs, and one day live off the investment portfolio as passive income through either dividends or selling down small parts of the position, but maintaining the bulk of the capital. If you want to see how these companies make money in detail, watch the playlist shown in the end screen. Let me know in the comments what you think of this ETF and whether you currently own any shares or plan to buy. If you enjoyed the video, leave a like and subscribe to the channel for more investing and Tesla videos. Thank you for watching, and I'll see you in the next one.